the balance has shifted. The middle class and the lower class are too disenfranchised. They're too beat up by the system.
And I'm like, housing shortage? No, it's an affordability shortage. It's a knowledge shortage.
They're saying that only about 28 out of every 1,000 homes changed hands between January and September of 2025, this year.
Nothing can stop me. I'm all the way up. All the way up. I'm all the way up. I'm all the way up.
Good morning, Vietnam. I am Mayoral Dallal, the host of the Money Matrix podcast, where smart money finds a smarter way. Today we have Jason Mantione in beautiful Florida somewhere, hanging out in the sun on a golf course. Our resident Jason Rod.
How's it going, everyone?
And, of course, our native Californian, Mr. Alan Hastings.
Alan Hastings, yes.
So today's going to be interesting because we're going to pop around a little bit, but there's some just things that are, now that the mayoral vote is really like literally right around the corner for New York, I really want to talk and loop back around a little bit on Mbanc because I just think there's so much craziness happening. We're going to talk a little bit about the housing market turnover and what that means and how it relates to what's going on in the mortgage market. And then we're going to talk about the job cuts due to AI and the CapEx spending and how that's going to affect the overall mortgage market. And I'm sure we're going to tie back into what the general consensus is after the rates were cut and see what's happening here. So let's jump right in. So I want to do like a lay of the land, Alan, if you will. If you can give us a little bit of the points of contention, if you will, and his winning points of Mr. Mbanc, what he's looking to do, what he's looking to accomplish for the people of New York City.
Sure. So I think the biggest thing everyone always talks about is the housing. Immediately, it's going to be a rent freeze on rent stabilized units, which is about 2 million units in the city. There's actually only 5 million available units in the city. So this would be 2 out of 5 apartments in New York would be rent froze. He wants to build 200,000 new affordable housing units in 10 years using publicly owned or social housing models. He wants to expand public housing rehab for 400,000 current public housing tenants. And then he's going to change the taxes in the city. So in the center of the city, in the boroughs where it's wealthier, he wants to raise the taxes. And in the outskirts of the city where it's lower income, he's going to lower the taxes on property specifically. He also has his economic stuff like raising the minimum wage to $30 per hour by 2030, potentially making the public transportation free, and then even more potentially city-run grocery stores. So those are the main points, but there are others.
So those are the main points. Now, if you really just look at it from a purely just, does this even make any sense? Again, in my opinion, it really doesn't. Just look at it black and white. It's impossible, especially for New York City, to be able to function and to be able to thrive, survive. I mean, just look at the minimum wage. I mean, just restaurateurs. Imagine you're going to have to pay your dishwasher $30 an hour. That's your basic busboy, your low-level guy, $30 an hour. Then what's your chef going to make? And what's your sous chef going to make? And then what are the prices of the food and everything? If you just look at it, it sounds like you're in Russia, like China, like a communist, like, hey, the government owns everything where it is, and this is where it's at.
I think it's government overreach, 100%. I'm all about less government in my life, and it sounds like a lot of people are going to be paying a lot higher taxes, and it's almost as if they're pushing investors out of New York City by all these different ideas. We do numbers for a living, and the math just doesn't work.
No, I mean, it's definitely, the math doesn't work, but it goes beyond that. I mean, look, something crazy that I saw that I think is interesting, there was a prominent figure in Manhattan real estate, like a heavy duty figure. I don't want to drop names, but most people figure out who I'm talking about, who just got indicted, him and his brother, for harassing tenants. And, because whatever it was, whether it be they wanted to get him out so they could up the rent or vice versa or whatever. But now imagine all of these people who have substantial buildings and whatnot. Now it's going to be rent controlled and rent freezes and whatnot. These guys are not going to be able to make it. It's not going to happen. you're going to create a mass exodus of real estate, of people, of the wealthy. It's not even going to be one class that's really going to do. So what are you going to do to the city as a whole? Because Long Island and whatnot, if you don't have vested interest in Manhattan, you're not affected by this. Westchester, whatever, you're not affected by it. This is really specifically in the 5 boroughs in New York City. So you're going to drive out the wealthy out of New York, and you're going to have to force them to do something else because you're going to tax them too much. It's going to be completely unaffordable. So what's that going to leave? I mean, remember when COVID happened and all of the office buildings got destroyed and all of that whole thing happened, then what happens now? What's this going to bring?
I was there when COVID happened. It was, to say the least, very scary. But you also got to remember this is only Manhattan, but a lot of these people that own these buildings and are the landlords and own these big companies, a lot of them live on Long Island. So you're going to have the businesses leaving. You're going to have people selling homes on Long Island, people selling homes because it's Long Island and Jersey, people that work in Manhattan. That's where they live. So if you can bear the ride in from Long Island, they live on Long Island. If they get tired of that, they go to Jersey. So living there my whole life, this is basically how it was. So that's going to be, a ripple effect that's going to affect a lot of other areas. I know a realtor who I spoke to yesterday. He's a Florida realtor, and he has heard that there's going to be a massive exodus through his pipelines that he has. And he's just in Florida and Tennessee. And he's hearing it. You're going to have it. It's going to be just like COVID with people leaving. These landlords, they're already talking. They're on podcasts. They're in interviews saying that they're going to sell their buildings and they're going to move and they're going to go buy other homes or whatever they rent out, office buildings, and they're going to do it in place. And they're talking Florida. They are building enormous high-rise buildings in West Palm Beach. There are a lot of big businesses that are moving here, have moved here, and now you're going to get more businesses moving here. So what does that do to Manhattan? What is he trying to do? Like, he's saying the things he says, they're going to be great, but they're not going to be great. He's literally ripping it down brick by brick.
Can I ask a question and really more of a challenge of a thought process for the team here today for us? In my life, I always find out that it's very easy to point out the negative, right? So the challenge is, and Alan, I know you'll have answers for this, but what are the positives to the things that he could be doing? Can we point out anything that's positive for two of you, that have lived in New York?
If you take your Jason and I's business sense out of it, and if we created a situation where we were just regular W-2 employees, if you will, we weren't business owners, we weren't entrepreneurs as such, but your average person who wakes up in the morning, goes to work, tries to make an honest dollar and come back home, for them, it's the greatest thing since sliced bread. Hey, I could be making more money. My rent's not going up. I could have free groceries. It could be a lot of things. That speaks to a lot of people because right now it's hard. Regardless of what anyone says, however people think the economy is good or not, it's hard. You see people struggling all the time. It's still happening. It's still there. It's very prevalent. I mean, you have a lot of people that aren't working. You don't see it as much, but it's there. So now they're thinking, okay, I got the government. They're with me. They're my partner now. That's the mentality that he's created. I'm your partner. It's a Robin Hood thing. I'm going to fight against the rich and give to the middle class. That's really what he's doing.
If I could jump in really quick. I love those points. And I think that's, you guys are both making great points. Yes, the wealthy will probably start to reevaluate. I mean, there's, Wall Street's there. Like, we're not going to see every single wealthy person, every single business leave New York City. I think he has to walk this tightrope of how can I squeeze the most out of these, larger corporations without scaring them away? Because you're right. If they all leave, all the money in New York leaves, then his plans won't work, right? Because he's taking the money from them. So if there's no money, then, nothing works. But you're also making a great point that the people who are on the, middle and lower classes where, let's be honest with ourselves, the economy is a system that relies on all of it. Some of the people on this call believe in trickle-down economics, and some people believe in the opposite, where communism and socialism are all about the working class being the backbone of the economy, and we have Reaganism, which is the top of the economy feeds the rest of the ladder. Both of these are valid in certain ways. And in the New York City race, what they're basically saying is the balance has shifted. The middle class and the lower class are too disenfranchised. They're too beat up by the system. It's too expensive. Houses are not affordable. You can no longer start business. You can no longer get out of this rut. And it sucks. You get a person who starts out and like you're saying, a W-2 mindset, wakes up, goes to work, can afford to go to work and live in the city. And then hopefully what they do is they start to move up the ladder. Then we get to see more small businesses. That's hopefully the plan.
But it's not just the city, though, Alan. Remember something. This whole thing is the 5 boroughs. It's Brooklyn, Bronx,
Right.
Queens, Staten Island too. So, and even though prices have gone up tremendously in Brooklyn and in Queens and all these areas, I remember when I was doing loans back there 10 years ago when we had a whole real estate division and everything. I remember the properties, the spec homes were just starting out $300,000-$400,000. You can get a nice 2-family house. That same 2-family house is $800,000-$900,000, sometimes more. I mean, certain parts of Jamaica, certain parts of Brooklyn, they're $3-4 million homes. You're talking about Brooklyn.
Crazy.
You could have never thought about that. I mean, I remember my dad had a property on Jefferson Avenue going back 20-something years ago. And it was a 4-family house, and we sold it for 400 and something thousand because we bought it for like 100. And he thought he made a home run on it. That's over $1 million property today. And it's
Crazy. Well, let me ask you a question.
Go ahead.
No, I'm just saying, since COVID and everybody's come back to work, you lost a lot of the high-end stores and the high-end restaurants, okay? So, yes, it's going to be cheaper for people to live and buy groceries, and they can live in the city. But what the city is basically, I grew up there. Let's go to the city tonight. You got dressed. You got the nice car out of the garage. You went to the nice restaurant. You stopped at the store. Maybe you bought your wife a nice shirt, or you bought the kids. It was an outing where you were going to go and spend money because you were going to go to the nice shops, the nice restaurant, take the nice car. So what happens to all of that? Yes, it's affordable for everybody to live, but the people that he's talking about that he's going to make it affordable for are not going to use the high end facilities, the restaurants and the shopping and all this other stuff that's in Manhattan that Manhattan thrives upon. Like, that's what they're known for. They're known for like Wall Street, high-end shops. What happens to all those people? So you're telling me it's going to be like South Philly? It's going to be, regular 5 and dime stores on the corner and regular, $10, $15 a plate restaurants? I mean, is that what it's going to turn into? Because who's going to go there? Already now you don't have people going to the city for one reason or another, whether it's fear or whatever. So you're going to lose all that. And that's what Manhattan is. That's what it's built on. That's how you know it. Me as a kid growing up and what I instilled in my kids, I'll show you pictures with their coats on, and we went to the circus, and then we went out to dinner and we're dressed, because that's what the city is. It's what it was. And this is telling me as a true New Yorker that this is going to be gone. It's really sad for me.
Anyways.
This is a great date night you painted.
Well, end of the exercise is great. We all challenged ourselves to go ahead and look at this through another lens. And we found some positives, but then we go back to our own realities and perceptions and measures. And at the end of it, what I've heard and what I take from what you guys have said is that although there will be more opportunities from people in the lower scale and middle pay rates, right, to afford things more, I also heard that taxes are going to be going up. Not the evil thing. Maybe the thing in the background of what I'm thinking is that as people make $30 an hour as a minimum wage, just to hold that as a placeholder, there's going to be more taxes on that. So how much are they really going to be going ahead and making extra to afford things? The reality is, he doesn't have a contract to go ahead and get free vending machines. Who's going to supply and maintenance those vending machines? And it gets you elected, but then when you get there, you can't do anything.
Politician.
So let's go to something very interesting, which is the housing turnover. Alan, you want to explain what I'm talking about, and then we can really jump in, because this is really significant, but you need to explain it and how it's relevant to our listeners.
Yes, this is actually super interesting. I just learned about this because I feel like I should have known this, because business for us is doing okay. But apparently, according to Redfin, Redfin, one of the largest housing data collectors in the country, they're saying that only about 28 out of every 1,000 homes changed hands between January and September of 2025 this year. So that's
How
the
many is that?
lowest level in
28 out
30
of a
years. Yep, 2.8% of homes is changing hands, changing ownership, being bought, sold, whatever. So in 2024, our average, basically the statistic is we dropped below the average by about 30%. So the reason for this, everybody seems to, speculate different things. The reason for this seems to be when you have a market, job market, economy, labor market, any of the stuff that's been going on this year that is unstable, that is unpredictable, you are less likely to make big life changes, change your job, have a kid, get married, right? And in general, those life changes are what drive you moving. Is you changing your house, you're getting a new room for that child that you're bringing into the world. You just got a new job somewhere else. You're getting a promotion. You can afford a bigger house. These are things that aren't happening. So the idea is that house purchases and sales are happening less as well. And it's one of those indicators where it's like, are we seeing the canary in the mine where the canary's passing out from all the gas in the mine and we got to get out of here? Like, is this a sign that the economy is super bad, that people aren't moving at all? They're just staying put.
Yeah, but it's not just specifically doom and gloom. It's some people saying, you know what? I don't want to go. I don't need to sell. I'd like to upgrade. I'd like to, you have a percentage of people, a good amount of people now with where their rates where they are, where they don't have to do anything. So I think it's not as simple as, 2.8% means the economy is doom and gloom and we're over. It's definitely not good, but I don't think it's as bad as it would be if we didn't have the last, 3, 4, 5 years of 2-3% rates. I think if our market wasn't positioned that way, we would be talking a different tune. But I think you have a lot of people who feel rates are coming down and they feel like, okay, I can wait a little bit. But we saw what happened. Every time rates get cut, the rates went back up. I mean, I just had a conversation with a client just this morning. Oh, you guys cut rates. My rate should be lower by a quarter. I said, actually, technically, I should raise it by 1/8 to a quarter because that's what the market shifted. What do you mean? So I pulled out the graph and I showed him, and he's like, oh, I'm keeping the same rate? Thank you so much. I appreciate it. Let's close right away.
Yeah.
It's just a matter of perspective. But if you look at it overall, though, it is still worrisome because you have different factors. You were mentioning about it's a low hire, low fire market that we're in. There's not a lot of activity, not a lot of job turnover. You don't have people bolting to different jobs because there's so many people that's available. When people have a job in this market, they like to stick because they want to make sure that they can guarantee that paycheck coming in each and every week, which is a big difference. And for your entrepreneurs, in my opinion, they're the ones that are really driving the market that we have right now. Your gig workers, your entrepreneurs, your self-employed people, your investors. Those are the people that we're seeing on a regular basis be doing this. Your average first-time home buyer is priced out of the market most times, unless they're just making that much more money and they don't have enough money to put down for a significant down payment. So they're going to those, 3%, 5% type of down payments things. We don't see a lot of first-time home buyers that are W-2 people putting down 20, 30%. We just don't see that.
I agree.
Say, because all the points you're making are fantastic, where you have to think about like the first-time home buyer specifically. You also have to realize that in a market like this, two different things are happening. One, with less movement, there's got to be more equity, right? If no one's selling or buying, those houses are just accruing equity. You have your values going up. You have people not selling, so they're just paying down their mortgage. You know what I mean? That's going to be refinanced in, hopefully this year, maybe next year. Refinances should go up. But the next question is, if you have those first-time home buyers trying to purchase, you have to think about it where there's way less supply for you. You can't, if people are listing their houses less, you got to be prepared when you find that house that you want to jump in there, to be like, I'm pre-approved, I'm ready to go. You have to find somebody who's nimble to do your financing. You know what I mean? Like, it's opportunity for us. Maybe that's why I didn't notice this as much, because our clients are kind of aware of this. They're kind of savvy. But as a buyer, you have to be like, I have to be fast on my feet now because I don't have opportunity to sit and wait.
No, I don't have an opportunity to look at this nationally, but I'm here in Arizona. I go all over Arizona, and I see all these huge housing developments that are sitting there, and some are getting filled up quite quickly, some aren't. We were in the market for a house earlier this year, so we were out shopping, and it's incredible to me when I keep hearing, there's a housing shortage. No, it's an affordability shortage, and it's what we're talking about. The right people having enough to put down and get into the house that they want, and not really being in the space, being a first-time home buyer, or maybe surrounded by people that have the knowledge to know that, hey, you want to put this much down to avoid PMI. This is what it really means when you're putting 3 and 5% down, and they're maybe not stepping it in steps. Like, this is my house for now. I will get to my dream home, not buying my dream home first. So it's strategies that people have. And the housing shortage, I mean, I hear it, I see the data, but then it's hard when I go out and I put my eyes on 500 houses on this track, 500 houses on that track. I see new construction. I see all the bulldozers working. I see all the guys out there working. And I'm like, housing shortage? No, it's an affordability shortage. It's a knowledge shortage of how to work it. And that's why it's important when we talk to our clients that we do that. We let them know what's the why.
In my opinion, I even think it's more of a knowledge than even an affordability. And I'll tell you why. Because rates go down, what's going to happen? They're going to say, okay, I'm ready to buy. But as a seller, what's your first thought process?
Raise the price of the
I'm
house.
raising the price of my house
Exactly.
because I have more people coming in. They can afford more. Well, I waited this long, and it's going to be a flip. You're going to see a transition from a buyer's market, which we're in right now, going into a seller's market. But it's definitely going to happen where you're going to see the flip. And for those that were smart enough that got in prior to, you're golden because you're going to ride that wave. But if you don't catch it, then what do you have? You now really have a true affordability problem. You didn't know enough to get there.
Yep.
I think it's a mixture of things. I think we were on a big incline of people moving from COVID. So that slows down there. You have also, it turned from a seller's market, where you were just saying about, and I agree with everything that everybody's saying. It was a seller's market, switched over to a buyer's market. You got all this talk about the rate. A regular person doesn't understand the rate like we do, like that we know it's already factored in, just like how your client called you today, Meyer. They see rates come down the news a quarter up. They think that their rate should be a quarter less. I think we're also in a wait and see. They're sitting and waiting and seeing. I didn't sell a year ago when it was a seller's market. I'm going to hang on to it, and I'm going to wait because I want more for my house than it's worth right now. A different generation also factors in. You have younger people that, not like how we were when we were growing up, that we wanted to buy our first house. Like, that was the world to us, to buy our first house, our generation. This generation today, that's not the most important thing. There's other things that are more important. They want to travel. They want to, not that anything that they're doing is wrong, but it's just different priorities. And I think all those things together is why you saw this big decrease and this 2.8% with all those things factored in. That's my opinion. And again, I agree with what everybody said, but that's my opinion of the why.
I would love
Alan,
to do.
You were very quiet today.
Yeah.
What are your thoughts?
I think it's a definite mixture between the rates that we got in COVID. People are just less likely to sell and refi now because they're sitting on that instead of trying to get into a 7 or a 6. And then, we have a generation of people that is prioritizing homeownership less. I think we're going to continue to see that number go down. I do. I think that's going to be, if things don't change, if the rates don't continue to drop, 2026 might be a lower number. And To kind of go back to the New York City thing without changing the subject completely, you guys are mentioning that like investors will leave, right? This is one of those markets where if you're seeing homeownership change over less, do you think that incentivizes investors more or less, right? Like, are investors going to buy now and hold knowing that they're going to be selling less because you have this turnover rate that's low? We're going to see a strategy change from people buying and holding long term for the cash flow. Do you think that that's something that's going to change?
Well, the rent control is an issue.
Not New
Right?
York. I just mean in general in the United
Oh,
States.
okay.
As
Yeah,
a
take it.
strategy, investors changing to a cash flow thing instead of like a development, ladder.
I mean, it depends on the cycle you're in, but yeah, I mean, there's definitely going to be a change in perspective. And before we wrap up, I want to just share a client that we just signed his loan docs the day before. The guy is a successful developer. He's got hedge fund money that backs him, and he does office buildings in Manhattan, also multifamily. And we were talking, and he is getting nervous about this whole Mamdani stuff. He doesn't live in Manhattan, but just all his business is in Manhattan. And he was at a 5%, 5.125%, something like that on his mortgage. And what we did is he said, you know what, Meyer, I got to start doing something just to make extra money. So he said, identified a couple of properties. I think if I take some money out of my home, what do you think? So I said to him, yeah, I think you should. So he took out $1 million. His rate went up to 7.125%. So his rate went up by 2%. But he ended up getting into a home that we're going to do financing for. He's buying it for 1.6. He's going to put about 600,000-700,000 into it and sell it for about 3.5 million.
Wow.
So all of the stress and everything that he's dealing with on the other side, he said, if I can do 2 of these a year, I'm good. And he's like, I'll just come to you, we'll get the financing and we'll do it. It's the change of the mindset to say, okay, you know what? I got lemonade on one side. I'm going to actually sweeten it up and do something else on the other side. And I think that really speaks volumes of what's going to happen. You're going to see change. You're going to see people going up, down, sideways. But at the end of the day, it's the ones that are in tune to the market that want to see the cash. Those are the ones that are going to get the opportunity. If you wait too long, it's just going to cost you more. You're not going to lose it. You're just going to cost you more, and you're going to have to fight harder for those deals. And those investors that we work with and those clients that have that vision and the foresight, they're going to win. That's the bottom line. Any parting thoughts for you guys?
Just one thing on what you just said, and it's for the people who don't know that. We encourage you to call us and talk to us about your scenario because we're the ones that can help you get to the level where the other people are at.
All right. Money Matrix Podcast. Alan, where are we? At Go Mbanc?
At Go Mbanc everywhere.
Thank you guys so much.
Aloha.
God bless.